All right, welcome to The Explainer. Today, we are going to tackle a force that quietly, and I mean quietly, reshapes our lives every single day. We're talking about inflation. We're going to break down what it is, where it comes from, and most importantly, what it really means for the money sitting in your wallet.
You know that feeling, right? You're at the checkout, you see the total pop up, and you just think to yourself, wait a minute, I bought the exact same stuff last week. How is it more expensive? That very experience, that feeling of your shopping cart getting smaller even though your budget is the same, well, that's inflation in a nutshell.
Okay, so let's put an official name to it. What exactly is this invisible force that seems to be nibbling away at our cash?
At its absolute core, inflation is all about purchasing power. See, it's not that the things you buy are magically becoming more valuable. Nope. It's that the money we use to buy them is gradually losing its own value.
Think of it kind of like a slow, steady leak in a tire. Your dollar's still a dollar, right? It looks the same, but it just can't take you as far as it used to. It's this quiet, persistent decline in what your money can actually get for you.
And if you want to see the long-term impact, get this. If you had $10,000 back in 1975, you would need almost $60,000 today just to buy the same amount of stuff. Let that sink in. That is the relentless power of inflation over decades. So, if inflation is the symptom, what's the actual disease? Where do these rising prices really come from? Well, economists generally point to three main culprits.
It pretty much boils down to these three: demand pull, cost push, and built-in. You can think of them as three totally different roads that all lead to the same destination: higher prices for everyone. So first up is demand pull. This is the classic textbook story of too much money chasing too few goods. Just imagine a brand new gaming console comes out, but the factory can't make them fast enough. Suddenly, everyone wants one. What happens? Well, prices get bid up. That massive demand is literally pulling the prices higher.
Then you've got cost push inflation. Now, this one isn't about crazy high demand, it's about the rising costs for the companies making the stuff. So let's say a big drought hits and the price of wheat just skyrockets. All of a sudden, it costs way more to make bread and pasta. The bakeries and food companies, they don't just eat that cost, they push it onto you, the consumer, through higher prices at the grocery store.
And finally, we have the trickiest of the bunch: built-in inflation. This one is all about psychology. It's about what we expect to happen. Think about it. If everyone believes prices are going to go up next year, what do? Well, workers demand higher wages to keep up, and businesses, expecting to pay those higher wages, raise their prices to protect their profits. And that, of course, just confirms everyone's belief the prices are rising, which leads to demands for even higher wages. It becomes this self-fulfilling prophecy, a feedback loop we call the wage price spiral.
Okay, so with those causes in mind, let's zoom out and see how this is all playing out on the world stage. Because inflation is definitely not a one-size-fits-all problem. It looks totally different depending on where you live.
Just take a look at these projected rates for July 2025. You've got places like Argentina and Turkey dealing with staggering annual rates over 30%. Meanwhile, the US is projected at a much calmer 2.7%, and Switzerland is practically at zero. The big takeaway here is just how incredibly different the inflation experience is across the globe.
And this chart really puts that contrast into perspective, doesn't it? You've got Argentina's economy just grappling with these runaway prices, the US trying to keep things in a more controlled range, and then Switzerland experiencing almost total price stability. Each one of those situations brings a completely unique set of challenges.
So, what's driving these big global trends?
Well, this quote here from the World Bank gives us a huge clue. It points to a key factor: the price of basic stuff, commodities like oil and metals. To put it simply, when global economic growth starts to slow down, the demand for all that stuff cools off, which can help put a lid on inflation. It just goes to show you how interconnected the whole global economy really is.
Okay, so we've covered the what, the why, and the where, but now let's get to the most important part. What does all of this actually mean for you, your bank account, and your financial future? So, here's the million-dollar question. Is inflation good or bad?
Well, it's complicated. It's a real double-edged sword. On one hand, it can boost the value of tangible assets, like your house, and it can even make old debts feel cheaper to pay back. But on the other hand, it absolutely decimates any cash you have saved up, it hurts people on fixed incomes, and, well, it makes everything more expensive for all of us. It really depends on which side of that equation you're standing on.
So ultimately, inflation creates clear winners and losers.
If you own assets like property or stocks, or if you have a big loan with a fixed interest rate, inflation can actually work in your favor. But if most of your wealth is just sitting in a savings account, or if you live on an income that doesn't go up with prices, then inflation is basically your worst enemy. So the crucial question is, what can you actually do to protect your finances? Well, historically, certain kinds of assets have tended to do better during these inflationary times. These often include things like stocks, since company profits can rise with prices. Commodities like gold are another classic example. And of course, real estate. Some governments even offer special bonds, like TIPS in the US, that are specifically designed to protect you from inflation. And all of this leads us to one last really crucial question to think about. Central banks like the Federal Reserve in the US often say they aim for about 2% inflation. They believe it's the sweet spot for a healthy, growing economy. But is that 2% really a sign of stability? Or is it a slow, steady, officially approved tax on the money you've worked so hard to save? That's the central dilemma here, and it's something really worth thinking about.
Thanks so much for watching today's video on Life 1+1. I hope you found it helpful and easy to understand. If you enjoyed this, don't forget to hit that like button, subscribe to the channel, and turn on the notification bell so you don't miss any of our upcoming videos.